Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, the last week has been particularly interesting. Now, the market's been trying to find a narrative, and we've had the beginnings of what has looked like an unwinding, an aggressive unwinding of the reflation trade. But before I get onto that, if we rewind back to last week, you remember the Federal Reserve had a meeting, and after that meeting, they said that inflation was going to be higher than they previously predicted. And there was talk of the first interest rate rise occurring a year earlier than previously thought. So that spooked the market. And the market initially, we saw gold slump. And actually, by the end of last week, it was down about 5%. We saw other markets start to show signs of weakness. We saw commodity markets pull back a bit, but overall, equity markets were pretty sanguine about it. They took it in their stride, and we did see a pop in yields on bonds. The 10-year US Treasury yield, for example, rallied higher, which you would expect because in an inflationary environment, you would anticipate that bonds would do badly, so people would sell them, meaning the yield went up and therefore the price of the actual bonds fell. Remember, yields on bonds move in the opposite direction to the underlying price of the bond itself. Now, you would think that logic would dictate that the reflation trade would kick into gear after the Fed's announcement. But you couldn't be further from the truth, because what we actually saw was a rapid repricing of assets subsequently. So from Thursday onwards, we saw the yield on the 10-year US Treasury plummet. And by the end of the week, we got down towards 1.35%, which is a 3-month low. That is in complete contrast to what you thought would have happened. And it meant that people were flocking into bonds. And that, as I say, is counterintuitive. We also saw a rush into growth stocks and a rotation out of value stocks. So the complete opposite of what the reflation trade has been. So people were selling value stocks, going to growth stocks, which means that you saw a big rally in technology stocks at the end of last week. So the reflation trade started to fall apart. I like to look at particular indices just to give people an idea of these moves. If you go and look at the XLK ETF, for example, now that mirrors the movement in technology stocks in the US, and that was up 1.6% in the days between Wednesday and close of play on Friday. If you look at financials, that's XLF if you want to find it, they were down about 3.1%. That's a huge difference. That's a difference of over 4%. So if you were holding on to assets that were doing well in the reflation trade, you would have been hurt quite badly in the last couple of days of last week. Similarly, those things had lagged. So growth stocks, for example, that would be technology. Stocks are a very good example of growth stocks. Then they have done particularly well. Now, if you look at the wider index, rather than just the individual sectors themselves, the tech-heavy NASDAQ was flat for the week, or in the days, I should say, after the Federal Reserve's announcement, so Wednesday, Thursday, Friday, while the Dow was down around about 2.5%. It also meant that energy stocks did badly, because don't forget, energy stocks have been doing well as part of the reflation trade. That fed into the FTSE 100. So the FTSE 100 started to lag some of the other global indices because of their exposure to energy stocks. And what it meant is that the market narrative was, the market was trying to find one. I mean, we saw some pullback in some equity markets, but like I say, this rotation into or out of the reflation trade and into things like technology stocks was completely counterintuitive to the idea that we were going to see inflation higher than we'd previously thought, and possibly we might even start to see interest rate rises happen sooner rather than later. So why was that happening? I mean, profit taking, possibly. Maybe the reflation trader got away from itself and people were becoming nervous. We might get a wider equity market pullback if the Fed, for example, started raising interest rates and pulling back on its QE. Was there an element of portfolio rebalancing? Was it, like I say, just a flight to safety as well that was going on? People just rushing to bonds? What happened is the market was starting to try and find a narrative by the end of the week. And the narrative it seemed to settle upon is the idea that the Fed would ultimately tame inflation. So it was starting to make noises to move towards possibly containing inflation. And therefore, ultimately, despite them predicting it might break a bit higher than previously expected, they were going to take action, which would mean that inflation would probably be snuffed out. So the whole idea of inflation running wild and a reflation trade to benefit from that didn't make sense. So people started selling out of those things and going into the things, like I say, that had lagged, like technology stocks, for example. But then go to Monday. Come Monday, the market narrative had complete reverse once again. And we saw a spike in all of the reflation trades that had done well. So we saw bond yields start to rally again. So after they crashed down to 1.35%, they started to rally. We saw the financials do well. They jumped about between 1 and 2% on Monday. Energy stocks did well. Technology stocks, by contrast, started to lag. So we are at this point where the market is trying to make sense of what's happening with inflation, what the Fed could do or will do, what other central banks will do. In fact, just today, the Bank of England has announced that they are still taking a very wait and see approach and aren't rushing to withdraw any kind of stimulus from the market in the UK. So interest rates are going to be kept at their all-time low for the foreseeable future. That obviously weakened the pound. So we've got the market flip-flopping between this idea of buying the reflation trade assets, so things like financials or the Dow Jones, for example, and then the next day doing the complete opposite. So where are we at the moment? If you look at those reflation trade indicators that I just mentioned, and you can see that financials are down 3% since the Fed's announcement last week. Contrast that with technology stocks up about 2.6%. So while the movements have started to become less aggressive, there's still quite a contrast. The 10-year US Treasury yield is around about 1.5%. Overall, equity markets are still at or near all-time highs. Technology stocks, i.e. the NASDAQ, has just hit an all-time high. So we are at the point that equity markets are still sanguine. We're seeing some quite aggressive rotations in the last week, but they've started to settle slightly. The question becomes, is it too early to say the reflation trade is dead? And are we going to see a rotation back into growth stocks, or are we going to see it get another lease of life? Don't forget, we've been here a couple of times already this year. I mean, it depends a lot on what happens in the coming days and weeks. We've had a lot of the Federal Reserve officials speaking this week, trying to take a more dovish tone than they did last week. So that's what's caused some of the market to calm down a bit. And also why we're still seeing equity markets push to all-time highs. If the market gets concerned that the central banks are going to become too hawkish, then it could see a pullback in equity markets, which is something that central banks do not want to see, despite what they say. Now, before I finish, another asset that it's worth mentioning about is Bitcoin, because we've seen some aggressive moves in Bitcoin again this week. We crashed below that $30,000 mark. That's a key technical line if you look at technical analysis. Anything below that is negative for the price of Bitcoin and could spell more negative sentiment and an unwinding of that market if it stays below that. Anything above that level is quite constructive. Bitcoin did recover and is back above the $30,000 level. But the reason it happened was because there were some more negative headlines out of China this week, which suggested that there would be further clamped down by the authorities there. But overall, as I've mentioned in previous episodes of this show, that Bitcoin is a bit of a sentiment indicator for investment markets generally. When it's rising, it shows some animal bullish spirit. When it's falling, then that's obviously an indicator of some negative sentiment more generally. So if we see Bitcoin crashing, then that may not be a good sign for equity markets going forward. But as I say, at the moment, equity markets are either at or clinging to new all-time highs. But it doesn't mean they're going to stay there forever, because the market is definitely still searching for a narrative. So that is it for this week on Damien's Midweek Market. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, moneytothemasses with the number 2. You can find us on Instagram, Facebook, and of course, don't forget to subscribe to our YouTube channel.